Everybody wants to find the holy grail in trading. Spoiler alert, it doesn't exist, but a diversified portfolio comes pretty close. Starting with a basket of strategies, I'll show you how to harness the efficiency of genetic evolution to automatically build a high-performing diversified portfolio. Building a diversified portfolio lets you enjoy higher risk-adjusted returns and shorter periods of stagnation. By spreading your eggs across multiple baskets, you will be more resilient in changing market conditions and have less worry about any single strategy failing. The key to diversifying your portfolio is to select strategies that are uncorrelated. Uncorrelated strategies do not win or lose money at the same time. I will illustrate this with a simple case study. I have a simple two-strategy portfolio consisting of a M30 Euro dollar and a M30 pound dollar strategy. To check their correlations, I first construct a correlation matrix in QuantAnalyzer. The number displayed above is the Pearson correlation coefficient. It ranges from -1 to +1 and indicates the level of correlation between the strategies. A value of -0.02 means the strategies are practically uncorrelated. So let's proceed to combine them in a portfolio. The portfolio equity curve is created by combining the trading results from the individual strategies. Looking at the metrics, the portfolio's return over drawdown is higher and its stagnation lower than either of its two strategies alone. Why is this so? The returns from your individual strategies are additive, meaning you simply add them up to get your total portfolio return. With a diversified portfolio, however, your strategy drawdowns are not additive. Your portfolio drawdown should be less than the sum of drawdowns from your individual strategies. The net result is that trading a diversified portfolio gives you much higher risk-adjusted returns than trading any strategy in isolation. This reduction in stagnation for your portfolio can be a big deal, especially if you trade for income. The pound-dollar strategy, in isolation, had a dreadful 1300-day stagnation, but thanks to the euro-dollar performing well during that period, the overall portfolio stagnation dropped to only 650 days. The strategies you select for your portfolio should concurrently satisfy these two conditions. They should have the highest performance, as measured by your favorite metric, and they should have low correlations with other strategies in the portfolio. The challenge is that portfolio performance and correlations are interrelated. Suppose you wanted to build a 5-strategy portfolio manually. The process would probably look something like this. From your initial basket of eligible strategies, you first shortlist the 5 top-performing strategies, strategies A to E. You realize that strategy E is highly correlated with A and B. So you remove strategy E and replace it with a slightly lower performing strategy, F. But now you realize the new strategy F is correlated with C and D. If you are building a large portfolio manually, it becomes very difficult to select strategies that are both high-performing and uncorrelated. If your strategy basket contains a good mix of trend and counter-trend strategies, or strategies across a range of time frames, you will probably have fewer issues with correlations. But what if you're a die-hard trend trader? I know of many retail traders who only trade trend strategies on the higher time frames, partly because such strategies typically require less monitoring. You could have serious correlation issues in that case. Fortunately, QuantAnalyzer has solved this problem for us. QuantAnalyzer's Portfolio Master uses a genetic algorithm to build high-performing diversified portfolios. In a nutshell, the genetic algorithm mimics the process of human evolution, whereby the portfolio is repeatedly modified to better meet our performance requirements. You just need to load your basket of strategies and input your portfolio requirements, and a portfolio master will do the number crunching for you. Let's do a case study and build an 8-strategy portfolio with QuantAnalyzer. Let's start with strategies from 4 30-minute markets: Euro-dollar, Pound-dollar, Dollar-yen, and Pound-yen. There will be 10 trend-following strategies for each market, giving a total of 40 strategies in the basket. These strategies were developed from 2003 to 2020. To reduce correlations, the final portfolio will only contain a maximum of 2 strategies from each market. Once your strategies have been loaded, you first need to select whether to use brute force or the genetic algorithm for computation. If you select brute force, Portfolio Master will simply iterate through every possible portfolio combination. This means you will arrive at the best possible combination, but be prepared for long computation times. For this case, we have a total of 77 million strategy combinations, so let's use genetic evolution to save time. The flip side is that genetic algorithms operate on probabilities, so it is not guaranteed that you will obtain the optimal solution. You can specify your genetic evolution settings here. I have found the recommended values to work very well. The out-of-sample option lets you reserve some data to test for curve fitting. With the 30% out-of-sample selected above, only 70% of the 17 years will be used by the genetic algorithm for portfolio building. The remaining 30% will be used to verify that the portfolio still performs well using previously unseen data. Later, we will apply a profit factor filter to this 30% out-of-sample portion. I recommend checking the last two options here. For the first one, since genetic algorithms operate on probabilities, there is a small chance that successive evolutions fail to lead to improved portfolios. The evolution will restart if this happens. Secondly, let's make the algorithm run until we decide to stop it. This will give it more time to arrive at an optimal portfolio. Next, we select our basket of 40 strategies and specify our final portfolio size of 8. Here I specify that the top 20 portfolios will be saved. Next, we'll select our ranking or fitness function. The return over drawdown ratio is a decent choice for a simple risk-adjusted metric, so let's go with that. Sectors selection is where we will apply our constraint of having no more than 2 strategies per market. We will first need to add a node column to the strategy data bank and type in a unique identifier for each market. In this case, the identifier is simply the market being traded. The algorithm will scan through each portfolio and make sure the node specified is found no more than twice. Remember we talked about correlations? Here is where we will specify the maximum correlation coefficient. This is the maximum allowable correlation between any 2 strategies in a portfolio. I consider coefficients of 0.4 or more to indicate significant correlation, so I will use that. If you are building a larger portfolio, you may wish to use a slightly larger value here. Since having a few moderately correlated strategies in a large portfolio is unlikely to be a problem. This is the strategy metric that will be used to measure correlations. I always use the profit or loss over a certain time period, since this is what ultimately determines your bottom line. This is the time period over which the profits or losses will be measured. A weekly time period will be used because I am trend following on the 30-minute time frame. If you trade very short-term strategies, hour or day would be more appropriate. This affects only the appearance of the correlation matrix, which we will check later, so you can ignore it. If you leave allow negative correlation unchecked, large negative correlations will be colored red in the matrix. And lastly, when you compare strategies that were developed over different historical periods, there will be periods when one or more strategies has 0 trades. If you check Add Empty Periods, a 0 correlation value will be assigned to the period with no trades. If unchecked, these empty periods will be ignored. Since all the strategies in a basket were developed over the same 17-year period, this option is not relevant. For data range, we can limit the date range over which the portfolio is computed. I will select full available to use the full 17 years. And lastly, let's set our portfolio filtering conditions. These are the benchmarks that the portfolio will have to meet. To keep it simple, I will add a 1.5 profit factor to the out-of-sample portion. With this condition, portfolios that don't meet the profit factor requirement will be dismissed. That's it. Now let's run the computation for 15 minutes. The top 20 portfolios are now in the data bank. Let's select the best portfolio and examine its results. Each currency pair is represented twice in the 8 strategy portfolio. so the sector's selection feature has worked well. Portfolio stagnation is 233 days, which is not too bad for a 17-year period. To inspect the out-of-sample segment of the portfolio, select Portfolio Only at the top left. The 30% out-of-sample segment we selected earlier is now highlighted in blue. It seems to perform as well as the in-sample segment, which gives us confidence that the portfolio was not curve fit. If you want to look at the performance of the individual strategies in a portfolio, head over to the Overview tab and select the SQ with Portfolio template. Finally, we have to run the correlation checks. Select the Portfolio Correlation tab and input the same correlation settings as above. The highest correlation between any two strategies is only 0.31, so there's a good chance our portfolio is well diversified. Correlations do shift over time, however. The correlations above were computed over the entire 17-year history. Over that period, there may have been shorter periods of time when the strategies were more correlated. If you are concerned about how correlations may have shifted, you can recompute the matrix above using a more recent historical period. The ability to efficiently trade a diversified portfolio of strategies is one of the biggest advantages of algorithmic trading. Turns out building a diversified portfolio isn't that difficult after all. QuantAnalyzer's Portfolio Master will do the heavy lifting for you. Specifying your ranking function and portfolio constraints is all that's required. If you want to give QuantAnalyzer a shot, you can use the coupon in the description to get 20% off QuantAnalyzer. Don't forget to subscribe and happy portfolio building!